Corporate social responsibility, CSR, refers to the obligation of organizations to recognize and manage the economic, social, environmental, and ethical consequences of their activities while creating sustainable value for shareholders and wider stakeholders. Modern corporations operate as separate legal entities possessing substantial economic influence, and therefore their responsibilities extend beyond profit generation to encompass accountability for their impact on employees, customers, suppliers, governments, local communities, and the natural environment. Within the program, social responsibility is viewed as an integral component of corporate governance and strategic management, requiring organizations to incorporate stakeholder interests into long-term decision-making and organizational strategy. The framework defines CSR as organizations considering and managing their impact on a variety of stakeholders, reflecting the principle that businesses must balance commercial success with wider societal obligations. The concept of social responsibility is closely linked to stakeholder theory, which argues that organizational success depends upon maintaining constructive relationships with all groups affected by corporate activities rather than focusing exclusively on shareholder wealth maximization. Organizations rely on employees for human capital, customers for revenue, suppliers for operational continuity, governments for regulatory legitimacy, and communities for social acceptance. Consequently, strategic decisions must consider broader stakeholder interests to ensure sustainable long-term performance. Responsible organizations recognize that environmental degradation, unethical conduct, labor exploitation, or poor governance may generate reputational damage, regulatory sanctions, and financial risk that ultimately reduce shareholder value. CSR therefore supports both ethical accountability and strategic competitiveness through responsible business conduct. From a governance perspective, social responsibility extends corporate accountability beyond legal compliance. While legislation establishes minimum standards regarding employment, environmental protection, taxation, and consumer rights, responsible organizations frequently adopt voluntary practices that exceed statutory requirements. These initiatives may include carbon reduction programs, diversity and inclusion policies, ethical sourcing, employee well-being initiatives, community investment, and responsible supply chain management. Such actions strengthen organizational legitimacy and demonstrate commitment to sustainable development while improving relationships with stakeholders whose support is essential for long-term success. Increasingly, investors evaluate companies using environmental, social, and governance (ESG) criteria alongside traditional financial indicators, reinforcing the strategic importance of responsible corporate behavior. The program emphasizes that effective CSR requires a structured CSR strategy integrated into organizational governance and long-term planning. The first stage requires the board of directors to make an authentic, firm, and public commitment to CSR, demonstrating leadership and establishing the appropriate ethical culture throughout the organization. Board commitment is essential because social responsibility cannot be delegated solely to operational departments but must be embedded within corporate purpose and strategic decision-making. Strong leadership ensures that CSR becomes a strategic priority rather than an isolated public relations initiative. The second stage involves determining the critical business objectives and priorities of the organization before developing CSR initiatives. Social responsibility should support strategic objectives rather than exist independently from business strategy. Organizations should identify areas where responsible practices create competitive advantage through innovation, customer loyalty, operational efficiency, risk reduction, or enhanced reputation. For example, investment in renewable energy may reduce long-term operating costs while supporting environmental objectives, and employee development programs may strengthen organizational capability while improving social outcomes. Strategic alignment therefore enables CSR to generate both commercial and societal value simultaneously. The third stage requires organizations to develop a CSR strategy that contributes directly to the achievement of organizational objectives, followed by integration of CSR into organizational culture, governance structures, and strategy development processes. According to the framework, CSR should not remain a separate functional activity but should become embedded within corporate governance, strategic planning, organizational values, and decision-making systems. Integration ensures that ethical, social, and environmental considerations influence investment decisions, product development, supply chain management, performance measurement, and risk management throughout the organization. Social responsibility contributes directly to sustainable competitive advantage by strengthening organizational reputation, attracting skilled employees, improving customer loyalty, reducing regulatory risk, enhancing investor confidence, and supporting innovation. Organizations demonstrating responsible environmental and social performance often benefit from stronger stakeholder trust and greater resilience during periods of economic uncertainty or reputational challenge. Conversely, failure to address social responsibility may expose organizations to litigation, consumer boycotts, environmental liabilities, and reputational damage that undermine long-term financial performance. CSR should therefore be viewed not as a cost but as a strategic investment in sustainable value creation and organizational resilience.